Go. Perfect. Okay.
Perfect.
I'll let you take it away, sir. Thank you so much.
Well, thank you. That was just so nice. Hello, everybody. I want to tell you something. First of all, with this new tax law, this is probably one of the most significant economic and tax changes to have hit this country I can remember. So this is just a huge deal. And for those of you in network marketing, which most of you are, this is just a phenomenal benefit for you. And from a recruiting perspective as well, this is absolutely phenomenal. So this is something you really want to pay a lot of attention to. Now, I'm going to go very quickly. I'm a New Yorker. I can speak at 60 miles an hour with 120 mile an hour breeze. And hopefully I want to finish by around 10:05 or so. And then we could take some time for questions. But a little background about me. I mean, Sonia did a wonderful job of introducing me. I'm a CPA. I'm a tax attorney. I'm a former IRS trainer of attorneys around the country. So if you think of an IRS agent as a rat, I guess that makes me the head rodent. I've been lecturing for many, many years at the Tax Reduction Institute, showing people how they can reduce their taxes and yet bulletproof their records. I'm a best-selling author of a book called Lower Your Taxes Big Time. And I have another book, which is garnering some terrific reviews, called Achieve Financial Freedom Big Time. And all my books you can get on Amazon and Barnes & Noble and all these other places. And I'm a guest tax expert on Fox, CNN, CBS, and CNBC, among other places. And I'm not saying this to impress you. I'm saying this because I want you to know that I know what I'm talking about. Because I am going to be covering some surprising things. There's no question about that. You know, as I said, Congress passed probably the largest overhaul of the tax system in 4 decades. And these are tremendous opportunities for self-employed individuals. But as I'm going to show you today, not all savings are automatic. Many people will overpay their taxes. They're going to overpay this because they fail to change the way they operate their business. But not you. You're here because you're action takers, and I certainly applaud your proactive actions. So it's important to understand how the tax structure has changed. I want to give you a little overview. This is going to help you see how the new tax law will benefit you. And to accomplish this, we first need to know who the players in the game are. First, there's Congress. And they're the ones that make the rules on how income and taxes work between the other players. Now, the other players are you, your business, and of course, the IRS. Now, I want to address something that's been talked about a lot in the media because it's caused a lot of confusion for small business and self-employed people. And frankly, it doesn't even apply to most of you, but it's actually the centerpiece for this whole tax change. And there's another big bonus that hasn't been explained very clearly that we're going to discuss on the next slide. But first, let's talk about the main thing of this tax law, and that is lowering the corporate tax rates. The new lower rates only impact businesses that are set up as regular C corporations. Now, if you don't know what a C corporation is, it's probably safe to assume you're not one, okay? But all public companies are C corporations. And so are most businesses that raise a lot of capital from investors. So the bottom line is, now let me give you a little background here. They may have been as popular for small businesses, and that's because they have a lot of strange rules. Let me explain. When a C corporation makes a profit, it pays the IRS taxes directly. After it pays these taxes, then the business can pay dividends to the owner. And then the owner itself pays taxes on the dividends. So the IRS really receives taxes twice. This is called double taxation. Now, the new law lowers the rate that your business pays the government. In the slide, it's that orange arrow that you can see. The rate has been dropped from a maximum rate of 35% to a flat rate of 21%. But this double tax scenario is still there. Anything that's distributed to the stockholders paid as a double tax, as dividend. So as I mentioned before, most of you are not set up this way, and therefore it doesn't apply to you. And for most of you, I don't even recommend it. So let's move on and talk about what does impact you. Most of you are probably set up as an LLC or a sole proprietor or an S-Corp. These are considered pass-through entities. And that's because your business doesn't pay tax to the IRS directly. Your business reports its income to you. And then you report the income to the IRS. Unlike a regular corporation, you pay the tax individually. You also pay taxes on your personal tax returns. Let me illustrate this with an example. Let's assume that your business makes $50,000 in profit after all your expenses and deductions and so on. At tax time, you would report that income on your personal tax return. But before you do that, you have to, let me get this right, you have to add in any other personal items, personal income, such as another job income or income from a spouse or dividend. So in addition, maybe you sold some property. All of that is money you got to pay taxes on. And all of that money, you, as I said, you pay taxes on. So here's how it works. First, you take your business income, whatever your net income is from your business, you subtract any deductions from that business, and then you add any personal income that you had, such as dividends and interest. And this is called your adjusted gross earning. Let me back up for a moment here. Well, now, then you get to subtract any personal deductions that you take on your tax return. And this includes either your standard deduction, keep going forward for some strange reason, back up here. I have technical difficulties.
Let's get away.
Yeah, let me back up here. Okay. And the new law, by the way, lets you take your profit. If you take all your personal deductions, so you get what is known as net taxable income. This new law lets you take your profit and multiply it by 20%. So in this case, you made $50,000 of net taxable income. You would get a $10,000 extra deduction. And this deduction you take on your personal tax return, which reduces your taxable income. So effectively, you're winning several times here. Number one, you're lowering your taxable income by roughly 20%. In addition, you're getting lower tax rates. Plus, you get more in deductions than other people would get. Do you see that? So by the way, if you own multiple businesses, this is something that the media isn't telling people, you get this 20% deduction for each and every business that you have. So I want to make that very clear. So overall, the new structure is absolutely fantastic for small business. But I want to caution you, there are a lot of changes in this new tax law. The game is basically fundamentally changed. The rules about what you can and cannot deduct, as Sonia has mentioned, have changed. And in some cases, it's changed dramatically. The new law took away some deductions that you've gotten used to, but it's also created new ones. Overall, the changes are pretty great, but you need to know what the new rules are in order to get the maximum benefit from the new tax system. And that's what we're going to hopefully shed some light on today. That's going to be my goal. But before I go any further, I want to share a little fun experience I had recently. My partner in TAXBOT did something really kind of fun. He invited me and 7 self-employed people to bring their tax returns to our office. And by the way, you can see 8 people in this picture because one of them brought their spouse. All of these people were strangers to me. Then my partner challenged me to find $10,000 in missed savings on each of their tax returns. All I had to do, and by the way, I had to do it in less than 10 minutes to make it a little bit harder. And to make it even more hard, my partner made sure that all of them had either used a professional CPA or used a brand name online software to file their taxes. Well, I'm proud to say that I went 7 for 7. I found at least $10,000 in missed savings for each of them. And my average time was less than 6 minutes for each of them. And it wasn't even that hard to do. Now, with this in mind, I want to make a point. All of the underlying reasons that these people overpaid their taxes are still in the new tax system. In fact, I bet I could review the same returns next year and find even more missed deductions. Now, why is that? Because most self-employed people, most small business owners overpay their taxes. You heard me correctly. And they will continue to overpay. It is estimated that they overpay by billions each year. That's billion with a B, folks. And based on my 30 years of experience, over 95% of you probably don't think you overpay. Just like the 7 strangers that we've invited in. Now, why is that? There are a few reasons, but the biggest reason I see that most people believe is a myth. And that myth is 7 words long. And those 7 words are, my accountant takes care of my taxes. By the way, I have a similar myth. My spouse takes care of my taxes. And I want to make sure I'm very, very clear. I think everyone should use an accountant. I think they're essential. But don't fall into this trap. Let me explain what I mean. It's called, what I call it, the gym membership trap. Tax preparers have been given very painfully unrealistic timelines to do their best work. And here's the problem. When you go to a gym, and I see this all the time, and I go to classes, I take classes where I am. Everybody makes these New Year's resolutions. And sure enough, all my gym classes are absolutely full in January. But by the time March comes around in April, the classes tend to be empty and the regulars can go in with a lot less people. Well, the same thing is true with an accountant. Tax preparers have been given painfully unrealistic timelines to do their best work. Tax preparation is a time-sensitive activity. The clock really starts ticking on January 1st. And accountants have basically a mere 3.5 months to get your taxes filed. In Canada, it's maybe, I think it's 4 months, but that's it. Well, there are extensions, of course, but estimated taxes are still due by mid-April. A decent tax preparer will file somewhere between 200 and 400 returns each season. But most of these will be done in only 6 weeks. Why? People need time to gather their documents before handing them over. Even working a 12-hour day, that translates to about a little less than 2 hours to work on each tax return. Now, is that enough time? It's absolutely not, especially when clients are unorganized. In a way, the system is kind of engineered that it doesn't give accountants enough time to do their best work. Now, I absolutely believe that you should use an accountant, but you need to do your part. Hopefully that makes sense to all of you. So the question is, what is your part? You wake up and realize a few things. First, you need to realize that, frankly, there's a difference between filing taxes and tax planning. There's a difference between a tax preparer and a tax planner. Most people have an accountant, or they use some online filing software to do their taxes, but they don't recognize that there's a difference between filing taxes and tax planning. And I've noticed that wealthy people are at least 10 times more likely to be highly involved in their taxes because they realize it's frankly their responsibility to know a thing or two about these taxes. And then with this knowledge, they meet with their professionals and talk about the strategies. Now, so my mission is very simple, is to make sure that you never overpay your taxes again. And basically, I can help you do this in 2 ways. The first is I absolutely love to teach people tax strategies like we are doing today, and you can hear that in my voice. But the second way is my mission is that through my company TAXBOT, which is basically an application that makes it easy to track your expenses and stay compliant. But we're going to talk more about that later. For now, let's get into some of the new tax law changes. Before I talk about business taxes, I want to point out 4 changes in the personal tax side, because believe it or not, there are some very interesting ramifications for business owners like you. And they will be a lot more apparent later when we talk about the business changes. And by the way, for those of you on Facebook Live, I know some of you tend to want to go, oh, what's this? I advise you to listen to this. This is going to be some of the most valuable information you're ever going to get, I promise. I will put a lot of money in your pocket if you listen to me. And at the end, we're going to be taking some Q&A, which is also very important, that I think applies to a lot of people. So make sure you write your question down. We will take them later. All right, first personal deduction is the standard deduction. And this has almost doubled to $12,000 per person. It was going to be $6,500 this year. It's now $12,000. And that's if you're married. And that's if you're single. That's if you're single. If you're married and you file it jointly, then you get a $24,000 standard deduction on your tax return. Now, because of this increase, there's a lot of ramifications. More people will take the standard deduction rather than itemizing. And that's a much higher threshold to meet because your itemized deductions have to exceed this. And later, we're going to show you how this affects your business. But I just want you to just pay attention to this for a few minutes, okay? The next is property taxes and state and local income taxes. They've put a cap on them. There's now a limit in the United States of $10,000 that you can deduct on property taxes and state and local taxes as well. And this will really affect those who are in high tax states with high property taxes and high income taxes, places like New York and California. In fact, let's do an example. Let's assume that you had property taxes of $8,000 on your primary residence, and in addition, you owed some state income tax of $6,000. You add these totals together, that's $14,000. Under the new tax law, though, you could only deduct up to $10,000. And this results in a loss deduction of $4,000. And we're going to come back to this later on how you can get part of this loss deduction, how to get around this. Another change in the law is that you can only deduct mortgage interest of up to $750,000 in debt on your primary and secondary residence combined. But you Canadians, you don't have to worry about that because you don't take interest on your debt anyway, but then your house is tax-free. But what's interesting in the United States is that there's no limit on the interest. I mean, if you're paying 18% interest, that's okay. You're just limited on the amount of debt you have to pay interest on. And you cannot deduct any interest on a home equity line of credit anymore. So now, not all of you may have a loan greater than $750,000, but many of you do have a loan home equity line of credit that you've been getting credit for. And later, we're going to show you an interesting loophole for business owners to get around these limits. But I just want to show you what these personal items are and what you probably heard about when you listen to the talking heads on the media these days. Now, the new law also reduces the threshold for deducting medical expenses from 10% to 7.5% of your adjusted gross earnings. Now, this is a law that most people don't even know about, because basically it works like this. If you have high medical expenses totaling more than 7.5% of your adjusted gross earnings, then you get a deduction for medical expenses. Basically, you can deduct anything greater than 7.5% of your adjusted gross earnings. So let's take an example. Let's say you made $100,000 of adjusted gross earnings, and you had $10,000 of medical deductions, then you could deduct anything greater than $7,500, which is 7.5% of the adjusted gross, which is $2,500 of your medical expenses. Now, most of you don't fit in this scenario, but if I bring it up because there's some incredible things that you can do in your business that will allow you to deduct a ton of medical expenses, even if your expenses are not that high. In other words, there's a way to get around this threshold, okay? Now, okay, this is enough on the personal side. Now I want to talk to you about your business deductions. Before I do, I want to give you a little bit of a warning, sort of I guess a public service announcement. The tax game is frankly a very different game with a new tax law. And now it's even more important than ever that to keep good tax records, which means you gotta have a good tax tracker. You're gonna hear me saying this now, and you'll hear me say it again. It's becoming the absolute required thing for small businesses. You know, people ask me, what do I need to do to keep the government off my back? Having a good tax tracker is what you need. You know, with these changes, there'll be a few rocky years ahead of transition for businesses and accountants. Mistakes are frankly gonna be made. And the business deductions have improved so much that IRS is likely going to be looking very closely at business deductions. In fact, even before the new tax laws, here's an interesting statistic. IRS won 88% of audits it performed. Now, by the way, the rule in Canada is almost the same. They're like 86% of audits they perform. I mean, that's incredible. But the number one reason that both in the United States and Canada, these tax auditors win with that higher percentage was that the taxpayers, was a stupid reason, by the way, didn't have adequate backup records. And when I say that, I mean things like mileage logs, receipts, and other important records. These are the things that are needed in addition to financial statements and bank statements. And with all of these new deductions, the IRS will be watching very closely to make sure people are following the rules. And this is especially because the philosophy behind this new tax law is that it's going to create more growth in the long haul by creating jobs and encouraging investment. But the problem with this new tax law is in the short run, it means that the government will be collecting less taxes, which means they have a deficit. They still have bills to pay, so the IRS is going to be very keen on making sure that businesses have the right backup information. Make no mistake about this. The key is you want to think of an audit like a criminal investigation. I don't know if you're like me, I like watching these detective shows. If you're a suspect in a murder case, what's the first thing the detective asks for is your alibi. A good alibi will prove that you're not guilty. The IRS and the Canada Revenue Agency works the same way. They want proof of your expenses and your deductions. However, let me back up for a moment. In an audit, you're assumed guilty until you prove your innocence. In fact, you're better off committing a murder. At least there, you're innocent until proven guilty. Not true in tax law. And by the way, a credit card or bank statement will not be enough for the IRS or Canada Revenue Agency. If you don't have receipts and a mileage log, then your deductions can be and will be disallowed. But if you follow the rules and keep good documentation, then you have absolutely nothing to worry about. So really, you'll have that peace of mind of never having to worry about an IRS audit again. You'll simply breeze through an audit. Okay, that's the end of my public service announcement. Let's talk about saving money in taxes, which is my favorite thing. And we're going to start off with automobile deductions, which is a big change in the tax law. Under the new tax law, automobile deductions are insanely better. Oops, back up for a moment here. And if you know the rules and do it right, these deductions can easily save someone hundreds of thousands of dollars over a lifetime. I hope you heard me correctly, okay? First, you need to know that there are two methods of deducting your automobile for your business in the United States. In Canada, there's only one method. The two methods here are the standard IRS mileage rates, and then there's the actual method. First, let's talk about the standard IRS mileage rates. The standard mileage rates is used most often because they are easy to emphasize and easy to implement. Did I tell you it's easy? It's very straightforward. Basically, the IRS gives you a deduction for every business mile you drive for business, and that rate fluctuates from year to year. based on inflation and some other metrics. The rate this year is 54.5 cents a mile. Now, here's my question to you. Who has the burden of proof of determining how many miles you drive for business? Does the government or do we? And the answer is we do. And how do we do this? From our tax tracker or tax organizer. Is everybody getting the drift here? You know, if you use this method, you don't get to write off expenses, oil changes, gasoline, repairs, and so on. This is kind of a shortcut method. You simply take your total business mileage and divide by your, let me put it this way, you take your business mileage, divide by your total mileage, tracked in your mileage log, and you multiply it by 54 cents a mile. So you take your total business mileage, multiply it by 54.5 cents a mile, and that's the deduction you get for the entire year, okay? So in our example, let's assume we have 15,000 business miles multiplied by the 54.5 cents a mile rate, giving you a deduction of $8,175. It is neat and sweet. You don't need to get, you basically don't get to claim any depreciation for that car. That's because the rate of depreciation is already built into it. Now, under the new law, it will almost never be a good idea to use the mileage rates. That is, unless you're driving a really old car and you don't want to buy a new one. And you're going to see why in a few minutes. But basically, IRS has increased the depreciation without changing their mileage rates too much. So they made it much better not to use this method, okay? Now, if you're in Canada or in the US, you take what we call the actual method. Now, before I get to that, there's something you need to know in both countries as well. And I want to introduce you to a concept called business usage. Business usage, frankly, is pretty straightforward. It's the percentage you use your asset, like a car, for business when compared to your personal usage. To determine the business use of a vehicle, you simply divide your business mileage divided by your total mileage. So it's business mileage divided by the total mileage. In this example, let's assume you drove, I don't know, 8,000 miles for business out of 12,000 miles driven for the year. Your business usage would be 66%. I want you to remember this concept because we're going to use it again in a moment. Okay, the second method for deducting your car is the actual method. This is the method that's allowed in both US, Canada, and most other countries. With the actual method, you get to keep track of all your expenses throughout the year. So you got to keep track of things like gas, oil, repairs, insurance, wash, wax, and so on. Then we multiply that total by our business use percentage. Remember that? For the year. So let's do an example. If our vehicle expenses, let's say, added up to $12,000 for the year, and we drove it 80% of our mileage for business, then the operating part of our deduction would be 80% of $12,000 or $9,600. But we're not quite done yet because we get to depreciate our assets and take another deduction on top of that. The changes for depreciation have gotten much, much better under the new tax law. In fact, to illustrate this, let me give you an example. I'll give you a little pop quiz. Let's say that I owe you $1, okay? I actually owe you some money, $1. Which would you rather receive? The full $1 today, or would you take a quarter of that $1 each year, but I get to pay it off each year over the next 4 years? No interest, just a quarter over the next 4 years. Which would you choose? Hopefully, I hope you pick the $1 today. And the reason being, because you want to get all that money that you can and get it as soon as you can, so you can use that money for other things like investments. If you get the $1 today, then you can invest it and have more than $1 in 4 years. Does that make sense to everybody? Unfortunately, when you buy equipment, the tax code makes you deduct the cost over time. It's kind of like the 4-quarter scenario. For cars, it generally was set at a minimum of 5 years. So it was actually over 5 years. But under the old law, the government restricted the total deductions so you could take each year for vehicles on top of that. They put a cap. They placed a cap on that, which is called the luxury limits. And basically, the cap was designed to stop people from buying luxury cars for their business. And yearly maximums were actually pretty low. You can see this on the tax law. For example, the first year yearly limit was $11,160. But then after that, it was $5,160, third $3,050, $1,875, and so on for depreciation. So now the limits have almost tripled. You can see that in years 2 through 5, almost tripled under the tax law. So what does this mean to you? Let's take an example. We ran the numbers. Let's say you bought a new BMW for $50,000, all right? And let's assume you drove it 100% for business just to make my life easy. Now, that's probably almost impossible, but It makes the math easier. Under the old law, it would have taken you, get this, about 18 years to fully depreciate your $50,000 BMW. But under the new law, you can depreciate the same BMW, I want you to get this, in 5.3 years. Hope everybody saw that. 5.3 years instead of the 18 years. It's an incredible increase that I'm sure our automakers are going to absolutely. So the bottom line for you is that you can now deduct nicer cars much more quickly. Make sure that you talk to your accountant about the details of your situation before you go out and go buy a nice car. But I can just see the ads in the paper, buy a Mercedes, buy a Cadillac, buy a BMW, and eliminate your taxes. Of course, you also eliminate your cash, but I can just see these ads coming. And by the way, this is another reason why you want to have a business. An employee can't get right off of this. There's no more employee business expenses. But if you're in business, you can. This is one of the big benefits of being in business. Now, there are a few vehicles that can legally skirt the rules that say you have to depreciate your car or vehicle over time. The real winners, believe it or not, are the new tax law are qualified vans, qualified trucks, and qualified SUVs. For example, if you buy a qualified truck, you can deduct up to 100% of the purchase price in the first year. That's right. You get your dollar up front instead of quarters over time. And here's how you do it. If the truck qualifies, then you write off 100% of the cost multiplied by the business usage for that year. And it only works in the first year. So let's see how it works. If you buy a $50,000 qualified truck, let's say an F-150, and you drive it 90% for business, then you can deduct 90% of the $50,000 or $45,000 in that year. You bypass all the luxury limits and all the time restrictions. This is an incredibly powerful strategy to take advantage of, don't you think? So as I said, but you got to know about this, so you may not buy a new truck or a used truck. By the way, this applies to new or used trucks. So let's talk about what qualifies. What's a qualified truck? All right, the truck has to be, number one, built on a truck chassis. Well, that makes sense. Number two, it's got to be new to you. Now notice it doesn't have to be new, just new to you. You could buy a used truck, and that's okay. It's new to you. Number three, it must not have any rear seating, or you come under the SUV rules, not the truck rules. Number four, it has to have at least a 6-foot cargo area or bigger. Number five, and finally, it has to have a gross vehicle weight of over 6,000 pounds. And by the way, how do you find out whether your vehicle has a gross vehicle weight of over 6,000 pounds? Well, to find this number, you can Google your truck, or in an easier way, you open up the door jamb of the driver's side and the vehicle, and it's printed in the door jamb and some other information with the VIN number. You'll actually see an acronym GVW, or gross vehicle weight, listed there. If it says over 6,000 pounds and you meet these other criteria, you qualify. It's that simple. Now, let's talk about SUVs and vans, because they were the other winners under the new tax law. This was a huge change in the huge recent tax legislation. Under the new bonus depreciation code, which is something different, SUVs and vans now become very exciting, at least for the next few years. The truck deduction, frankly, has been around for a long time, and it's going to continue to stick around. You could have done this last year, the year before. If you didn't know it, you can file amended returns, in fact. However, this rule for SUVs and vans will expire over time. But in 2018, you're allowed to deduct up to 100% of the cost in the first year, just like trucks. So let's say I buy a Cadillac Escalade, which is an SUV. I pay $60,000 for it. I use it 90% for business. I can write off $54,000 in the first year. And I can tell you that every accountant I know is buying Cadillac Escalades. Now, so how do you qualify? What does an SUV have to do to qualify? Okay, first of all, it has to be on a truck chassis, just like a truck. Number two, it's got to be new to you. It could be a used vehicle, but it's got to be new to you this year. Number three, you've got to be able to carry passengers, in other words, rear seating. And number four, it's got to have a gross vehicle weight of over 6,000 pounds. And you can get that from looking in the insert in your door jamb. You'll see whether you have a gross vehicle weight over 6,000 pounds. It's that simple. And if you meet that, then you can deduct the business use in the first year. Okay, now I want to talk to you about something serious. You know, whether you use the standard IRS rates here in the United States or the incredible actual method, you must keep a mileage log. And I think this is going to surprise some of you. But if you claim an automobile deductions, you absolutely have to have a log. This is not just something nice or good. This is essential. It's part and parcel of the tax law. It is used to prove your business usage. In fact, every year, whether you're in the United States or Canada, you sign a tax return at the bottom of the form, and it says that you swear under penalties of perjury that you have written records to prove your business driving. I want you to think about that for a minute. How many of you have actually perjured yourself without realizing it? You know, in reality, the mileage log is as much for your protection as it frankly is for anybody else, and for the government as well. So let me explain. You know, because many people don't like to keep mileage logs, the IRS loves to audit this expense. I don't know if you know that, but that's the case. In fact, automobile deductions are the #1 audited area by both IRS and Canada Revenue Agency. And this is because, as you saw, these deductions are frankly worth a lot of money. And most people don't keep track of their mileage appropriately. But we're going to show you how to bulletproof yourself against even the harshest tax auditor, I promise. You know, remember we talked about the alibi before? Each time you drive for your business, you must write down or record an alibi. Now, you need to include the date of the trip, the total mileage, the beginning and ending odometer reading or address, and most importantly, a description of the business purpose. So let's take an example. For the date, you would record, let's take an example, let's say January 14th. For the mileage, you would say 35 miles. For the address, you would record 334 Make-Believe Circle or 123 Candle Lanes Drive. And finally, for the purpose, met with Johnny Appleseed about investing in my orchard. Now, I want to warn you about something about trackers. There are a number of trackers out there. For example, there's a famous one that did a lot of advertising, where if you swipe left, it's supposed to be business, and swipe right, it's supposed to be personal. But it doesn't necessarily ask you for the business purpose. And if you don't put this business purpose in, you are not compliant. And there's going to be a lot of people who use that tracker who are not going to be compliant, and they're going to be very surprised. I'll tell you that. So I want you to notice something else about what I did here. Notice how specific my purpose was. That is the key to a good alibi. The more specific, the better. If I had simply written meeting with client, then it might not hold up in an audit. It's too general. Everybody understand that? Okay. Keeping good records, I know, can be a pain if you do it manually, but we're going to show you how TAXBot can automate that for you later on, so you don't have to worry about manually doing it. Okay, so that's the great news. However, entertainment deductions have been completely eliminated under the new tax law. So I want to make that very, very clear. Therefore, taking your clients to play golf or to a sporting event are no longer deductible. Plays are no longer deductible in the United States. It's not true in Canada. In Canada, you could write off 50% of these things, but not in the United States. Those center court seats at basketball games are no longer deductible. Season tickets are no longer deductible. Box seats and suites won't be able to be written off. Likely, this ruling will surprise many entertainment venues, and it will be interesting to see how it benefits the NBA and the NFL. All right, that's the bad news, okay? Let's get to some good news here. Let's see if I can move my screen here. Here we go. Okay, let's talk about another change in the tax law. For years, I've taught people how to use meals and entertainment to grow their business and get a deduction for it. Now, back when they were debating tax cuts, they were considering getting rid of all meals and entertainment deductions for business. And as you saw, there were some changes. They got rid of entertainment. However, taking a client or prospect out for a meal still is, in our opinion, and the majority of CPAs I've talked to, deductible at 50% like it was before. Now, I got to tell you, most of the tax professionals that I've spoken with have said that they believe that the new law does not change the fact that you can deduct meals at a restaurant. But it's not clear, okay? I want to make that very clear to you. There are a few tax practitioners that feel that the new tax law does change things, but as I said, it's not 100% clear. So we take the position that since there's a good argument that the meal deduction has stayed around and that many other tax practitioners are also not only recommending that for their clients, but going to take it themselves, we recommend that that's what you might want to do. You might want to take that deduction, especially if you have the right documentation. So I'm recommending that everyone get the right documentation, no matter what. And we're recommending that for a couple reasons. Let's say IRS comes out and says, oh, it's not deductible, Sandy Botkin, you misinterpreted it. No, not deductible. We'll certainly notify you by publishing it on TAXBot and send you an email and put it in the newsletter. So I want you to know that. But currently, we're recommending that you take the deduction. And if IRS does come out with a ruling and says, okay, it's not deductible, first of all, if there's a lot of confusion, many times IRS has grandfathered people in. When they passed this Obamacare law, there was all kinds of confusion. So IRS actually grandfathered people in to avoid the penalties, sort of giving you a grace period. This has happened in the more complicated things. So that's another reason why you want to document all your entertainment. But let's assume IRS says you can't do it. Congress can say, okay, it was intended to be deductible, and they can then change the law. But if they change it, you're not going to get the benefit unless you document these 6 elements of substantiation. And finally, by the way, let's say the IRS still says no, and Congress doesn't change the law. You still want to document your meals at a restaurant when you talk to prospects, at least who the name of the prospect was and it was a meal, because that helps you associate the fact that you're in business and not a hobby. You're showing a reasonable expectation of profit. So you want to show you're keeping track of your expenses for that business. So we certainly recommend that you keep track of your meal expenses no matter what, particularly if you're doing that with a prospect, okay? All right, so it's vital that if you're going to deduct meals, that you have to have what I call the 5 W's and an H in your tax tracker or tax organizer. So what does that mean? Well, what it means is, number 1, who? What was the name of the person you entertained? Number 2, what type of expense was it? Was it a breakfast, lunch, or dinner? Now remember, entertainment is no longer deductible, so just breakfast, lunch, or dinner. Where? Where did the expense occur? I entertained in my home. I went to Outback Steakhouse. I entertained for breakfast with Tim Hortons. I like Tim Hortons. When? I did this on January 14th, or I did this on March 1st, 2018. Why? Be specific. This is your alibi. Remember, the more specific, the better. And finally, how much? If you do this, you'll have the peace of mind of never having to worry about a tax audit again, because your records will be in great shape. Okay? This is true for any type of meal, by the way. And we're going to get into some other types of meals as well when I have a whole seminar on meals. But for example, meals served, the only thing that we're questioned about is when you have a meal with a prospect. That's the only thing that is in dispute. But meals served at a seminar, for example, are deductible at 50%. When you're having a sales seminar, like an opportunity meeting, meals that you're serving are also deductible. That's clear. You don't have to worry about that. So, I mean, there are certain types of meals that are 100% deductible, but under all circumstances, you want to document it with the 5 W's and an H. All right, now I want to talk about a deduction that really hasn't changed, and that's the home office deduction. And that actually becomes even more powerful under the tax law because, as we discussed earlier, there's some limits with some personal deductions, specifically on your personal property taxes, with that $10,000 limit, as well as your mortgage interest deduction. Yet if you have a home office, you might be able to recoup some of the savings. Now, we don't have time in this presentation to get into what qualifies as a legitimate home office. I'll have a whole seminar on that. But I can show you where you can get more information on that later. But let me show you how this works. Let me do an example. Let's say that your house is 3,000 square foot. That's your total square feet. And you have a qualified home office that's 300 square feet. Therefore, 10% of the total square footage is used as business. Now, what does that mean? That means it allows me to write off 10% of my qualified home office expense as a business expense. This includes 10% of my mortgage interest plus 10% of my property taxes. So this is a way of getting around that $10,000 personal property tax limitation. Everybody see that? In addition, I can deduct 10% of my mortgage interest, so I get around the mortgage interest deduction because I can deduct that plus the mortgage interest of up to $750,000 of debt. Okay? So thus, the home office allows you to transform some of those personal deductions that are subject to these limits under the new tax law into business deductions with a home office. And you can also deduct all sorts of things like utilities that you weren't able to write off before. Also, you can write off things like alarm service, lawn care, insurance, repairs, maintenance, and much, much more. Again, though, you have to have a home-based business. Remember what I said? This new tax law is a gold mine for network marketers and other people who want to open up a small business. It really is. If you're just an employee, it's not going to help you much. But if you have a business, it does. Okay, now I want to talk about medical expenses. Now remember, if you have high medical expenses, and I discussed this before, You can get a deduction as long as it exceeds 7.5% of your adjusted gross income under the new tax law. Anything beyond that can be written off. Now, that's a pretty high threshold that, frankly, most people are not going to meet. Is there a better way? Well, there's something that many self-employed people can do to write off all of their medical expenses without a threshold. You heard me correctly. Yes, you can avoid the entire threshold, and the deduction starts at the first dollar, and you don't have any threshold to meet. And it's astonishing that most self-employed people don't do this or don't know about this. As a business deduction, this is how it works. So what's the tax plan strategy? It's called a health reimbursement arrangement, otherwise known as HRA. And I got to tell you, it's worth its weight in gold. If you're not doing this, you are losing thousands. I did this with my kids. I wrote off tens of thousands of dollars of braces and all kinds of other medical expenses that if you're not doing, you're overpaying your taxes. Remember I said you're overpaying your taxes? And here's how it works. There's a rule that allows businesses to put in place, and this is good for large or small businesses generally, that plan that reimburses employees for all medical expenses they have that are not covered by insurance. Now, you don't hear about this very much in corporate America because Fortune 500 companies, frankly, can't afford to pay for all their employees' out-of-pocket medical expenses. They can bill it, they just can't afford to pay it. It would be very, very expensive, and they can barely afford to pay for the health insurance as it is. But this is where it works great for small business owners. Usually, how it works is that you hire your spouse, okay, in your business to do something. It could be part-time, for example. It doesn't have to be that much. It could be for filing paperwork, for example. It could be for bookkeeping. It could be for delivering products. Now, if your spouse is already involved in the business, then you don't really have to change anything. All you need to do is to get an approved plan in place. Now, with your spouse, as a legitimate employee of your business, you can offer to reimburse them for out-of-pocket medical expenses that you pay for them and for family members, which means you and your kids. So you're getting a full deduction for this. And by the way, the reason there's no threshold is that this is not a medical expense. This is a employee fringe benefit. This is a business expense. That's why you're getting a full deduction for this. You're avoiding that threshold. And by the way, there's more on this I can talk about. We can send you some more information on this if you're interested, which I think you should be. Either put your name in the chat window and we can send you some information on this, or we can send you an email after the webinar. I can tell you that hundreds of thousands of small business do this every single year. And it's a strategy that's absolutely fully approved by the IRS. And I know my partner did this, and he saved something like, I think it was $24,000 over the last 3 to 4 years alone on medical and dental expenses. And I saved even more, by the way. And the way you do this, and there's also a special fiduciary that you need. They don't charge you much. If you want to find out more about it, just send us an email, and we'll send you the name of some good fiduciaries that can handle this for you. It's not expensive, about $40 a month, but it will save you literally tens of thousands of dollars, seriously. Okay. You know, I know I'm running low on time, so I can't go on forever. But I hope this gives you a little insight into just some of the ways the tax law has changed. The rules have basically been altered, and if you know about them, frankly, you can maximize the benefits and get out of what the new tax law provides. But the biggest thing that you can do for your businesses here is to get a grasp on the changes as soon as possible. You cannot wait for your accountant to teach you this stuff. I'm telling you that. Now, why is that? Tax preparers are entering their busiest time of the year. It's the old gym membership rule. And they're going to be swamped filing your 2017 taxes under the old tax code. The first half of the season is spent trying to find new clients and to get documents from their existing clients. And the second half is spent filing returns because of their crazy schedule. Many tax accountants won't have time to get trained on the new tax law until after the busy season. At that point, you have missed out on 5 to 6 months of tax deductions that you should have been using. You really need this information as soon as possible. I can't emphasize that enough. And that way you can make changes in how you think and how you run your business, and maybe change the entity that you're working at. And do it as close to January 1st as possible. Now, to help those of you who are interested in learning more about this, we have recently updated our TAXBOT University course. Now, this is an online class for anyone who is self-employed. We have spent hundreds of hours analyzing the tax law, and that we've organized it in a way that we can teach you everything you need to know in just a few short hours, I promise. And we do it in plain English, I promise. The format is very similar to our meeting today, except that we go deeper and we explore a lot more opportunities. We take the time to make sure that the concepts are fully understandable. Now on the screen, you'll see real numbers from the survey that we did several years ago. We followed with TAXBOT University. We followed up with past students of the class a year later, and we asked them to compare their latest tax return to the ones they filed before the class. I want to show you this. They reported finding an additional, get this, $20,000. Actually, it was a little over this. $20,000 in deductions on the average. I was absolutely thrilled with these returns, but I was not as excited, I'll tell you, as they were. For those of you who are interested, I want to show you how to get a discount on this class in a minute. But before I do, I want to also quickly share one more way we might be able to help you with the massive change in taxes. There's going to be a few rocky years in implementing the tax code. As you've learned, there's some insecurities or doubt about certain aspects of the tax law. There'll be some mistakes made by tax preparers who are getting used to the new tax law. There's no question about that. There'll be some mistakes made by business owners who don't know the new rules. And mistakes on tax returns create opportunities for the IRS and for Canada Revenue Agency to audit you. It's that simple. And if you work for yourself for 20 years, believe it or not, you have a roughly 1 in 3 chance of being selected for an audit. And your chances are actually higher if you start making some really good money. And as you learned earlier, the IRS and Canada Revenue Agency wins 9 out of 10 audits. The number one reason they win is that the taxpayers don't have receipts, invoices, and a mileage log. And this is the whole reason we started our company, TAXBOT. TAXBOT is an application that we developed to stop even the smartest tax auditor in their tracks. It is designed to automatically track mileage expenses and receipts according to both IRS and Canada Revenue Agent standards. First, TAXBOT can automatically track your mileage for you so you don't have to remember to do it. And if you're like most people, when you get into a car, your mind is focused on your next meeting. Or perhaps you're thinking about all the other things you need to get done, or some looming deadline. But the one thing you're definitely not thinking about tracking is your mileage. With TAXBOT, you don't need to think about it. TAXBOT can sense when you're driving. It effortlessly tracks all of your driving in the background, so you don't have to remember to do it. Later, when you have a few seconds, you can easily identify and classify your business trips. I designed TAXBOT for me. One thing I've learned, if it's simple, easy, and fast, I'll do it. And I think that works for most people. And I designed TAXBOT to be automatic as possible. For example, you don't even have to remember to turn it on. It turns itself on. When I open up the application, I will see my trips, including the timestamp, the total mileage, and the address. Plus, I can see a map of each trip, which very few expense trackers have done this. I can easily identify which trip is deductible for business and save them. TAXBOT makes absolutely sure that you get the information you need to stay absolutely bulletproof against even the smartest tax auditor. How will that feel? And by the way, at TAXBOT, how do we do this? We integrate it with a GPS system. That's how we get this. So it works anywhere in the world.